Welcome to Accounting 2010 Chapter 4 videos. Video 2, Closing Your Books and Preparing for the Next Period. In Video 2 of Chapter 4, we are going to close out the books for Roadrunner's Roost for the month of July 2015. So we're going to go back out to the workbook, the Roadrunner's Roost workbook. An Excel workbook is what we have been using, and each one of these are worksheets. We've been going from the general journal to the general ledger. We've got the unadjusted trial balance, the adjusted trial balance. We completed the 3 financial statements. And now, after the 3 financial statements are completed, the final steps are to close the temporary accounts. The temporary accounts are those accounts which are included on the income statement and the statement of retained earnings. Again, we had said in the previous video that these accounts are only for the month ended July 31st, 2015. Revenue minus expenses. They're only reflective of that time, as is the dividends account in the statement of retained earnings. And so we want to go ahead and close out that dividend account. Now, as it is in Roadrunner's Roost, there were no dividends paid, but we will still explain how this is done. The accounts in the balance sheet are permanent accounts. They are not closed. They will go forward from period to period. So how do we close these accounts? Well, the best way to remember how to close the accounts is through the acronym REID, R-E-I-D. And it helps us to remember that first we close the revenue accounts, secondly we close the expense accounts. We close these accounts to an income summary. This is a temporary account that is only used to close and move the amounts to retained earnings. And the fourth step is dividends. So let's just backtrack just for 1 second and talk about this. Through the process of preparing the financial statements, we are taking the revenue minus the expenses and coming up with net income. And in the financial statements, we are moving the summarized income and expenses, the net income, we're moving it over to retained earnings. So we need to have this movement of retained earnings reflected in our general journal and in our general ledger. So once we've prepared the retained earnings, we've moved the retained earnings over to the shareholders' equity of the balance sheet, which I have said the balance sheet houses permanent accounts. So in a sense, or in the actual situation, retained earnings on the balance sheet is a summary of the income statement, the statement of shareholders' equity. All of this is summarized and moved over to the balance sheet in the retained earnings section. So in the closing, we need to do that in the general journal and in the ledger. So what do we do? If you'll remember, revenue has a normal balance in which side, the debit or the credit. The normal balance is in the credit side. To bring the revenue account to 0, we have to debit the revenue account for the amount of revenue that we earned in the period. In the case of Roadrunner's Roost, it was $6,000. We are going to put the debit to tutoring revenue of $6,000, and we're going to put the credit into a temporary account called the income summary. And doesn't that make sense? We are summarizing the income that we have moved to the retained earnings. So we debit tutoring revenue, we credit income summary. Let's go to the ledger accounts and let's go ahead and look at what that would look like in those accounts. So we had a credit balance of $6,000. That is the $6,000 that the athletic department paid us. To close it, if we debit it, increases on the credit side in revenue, decreases on the debit side, we now have a 0 balance in the revenue account. We went ahead and credited the income summary account of $6,000. So we have that $6,000 revenue temporarily sitting in the income summary. Let's go look at the closing of the expense accounts. Because expense accounts have normal balance in what side? The debit. To bring those to zero, we have to credit them. So the sum of all those expenses was $4,864, which if you go back to the income statement, there it is. The total expenses were $4,864. The revenues. In that closing, we can have income summary $4,864. All of the expenses have been brought to zero. How does that look in the ledger? Well, I've closed each one of those by doing the opposite. They have a normal balance on the debit. I credit in that closing to income summary on the credit. So normally debit, I credit for the amount, bring each account to zero. Then I go ahead and move them temporarily through this process into the income summary account. So now they've been brought back on the debit side to the income summary because we're trying to summarize the revenue minus the expenses in the income summary. By doing this, we have what is equal to the income. We've summarized the income in this income summary through this process. Revenue minus expenses, the income has now been summarized. The revenue and expense accounts have been brought to zero. There is that income. We can move on. So we have that money, the $1,136, sitting in income summary, but it is only income summary is only used to summarize. We now have to physically, through this process, move that income summary into the retained earnings, which is what we did by moving the income statement income into the statement of retained earnings. We have done that, and it was moved then over to the balance sheet. Through this closing process, we have now actually physically moved that retained earnings over to the balance sheet. And if we look again at the ledger, we could go ahead and by debiting the income summary as I just did in that journal entry, I move this over. I can go ahead and put closing, and we can go ahead and subtract this out. If you see up above the formula, I've taken the 6,000 minus all of these debits. Now I'm going to go ahead and subtract out the summarized income. Now the income summary is at zero, and the credit can now be put into the closing retained earnings. It is all summarized, and now we know that the retained earnings has the proper amount of $1,136. If there had been dividends, we would have subtracted them from retained earnings, recorded the dividends, and now we would have had completely closed out all of those accounts. So all of our expense accounts are at zero. We have retained earnings of $1,136. The revenue account is at zero, and we are ready to start our books for the next period. How do we know after we've done all this that we are in balance? Well, we are going to prepare one final trial balance. We'll call it the post-closing, the after-closing trial balance. And the only accounts that should remain in your post-closing trial balance are the permanent accounts, or otherwise known as the balance sheet accounts. And if I look again one last time at the ledger, the only accounts that have balances in the ledger are the balance sheet accounts. The assets, the liabilities, the common stock, the retained earnings. Those are the only accounts that should have balances. We try them in the trial balance, see if the debits equal the credits after we've moved them from the ledger accounts. And yes, our debits equal our credits. We only have the retained earnings, the stock, the liabilities, the assets, and of course their associated contra asset. Those are permanent accounts as well. Our debits equal our credits. We have our final trial balance. We have just completed chapters 1 through 4, analyzing, journalizing, posting, unadjusted trial balance, adjustments, adjusted trial balance, preparing the financial statements, closing our books, the post-closing trial balance, and now everything all the way through our balance sheet, the left equal the right, on our final post-closing trial balance, our left equal our right, and now we can all sleep at night and we can move on to Chapter 5. We're going to be expanding from a service company into a company that sells inventory, and we will be talking about a multi-step income statement. We'll be talking about cost of goods sold, inventory accounts, and a lot of other interesting accounting issues.